Everyone is trying to sell you AI ETFs right now. 47 of them, 25 billion US dollars in assets. But here's what the marketing won't tell you. The average AI ETF underperforms the Nasdaq, and you're already likely invested in AI through your index fund. So why are people buying them? By the end of this video, you're going to understand exactly what these AI ETFs are, why most of them are marketing traps, why you probably already own an AI investment already without knowing it, what the elite investors are actually doing that most retail traders don't see, and my honest take on whether you actually need any of this. If you want more honest breakdowns like this, subscribe, because I'm posting 5 videos every week for long-term investors who don't want to get played by Wall Street marketing. The scale of all this. First, let's take a look at what's actually happening. As of April 2026, there are 47 exchange-traded funds with AI or artificial intelligence in their name or tagged as AI. Collectively, they hold around 25 billion US dollars in assets. And in the last 12 months alone, they attracted over 10 billion US dollars in new money. That's an enormous amount of capital flowing into products most people don't really understand. So let me actually explain what an AI ETF is in plain, simple English. An ETF, exchange traded fund, is specifically a basket of companies the fund manager has decided are related to artificial intelligence. Chip makers, software companies, data centers, robotics firms. Sounds smart, but in practice is a little bit more complicated than that. The 17-point gap. This is the number that stopped me when I read the research in the Morning Star. Between the best performing AI ETF and the worst performing AI ETF, there was a 17-point percentage gap in the average 12-month period. Same theme, same marketing, but wildly different results. Let me give you one specific example. The largest AI ETF by assets is called AIQ, Global X Artificial Intelligence and Technology. It holds over 80 different stocks and spreads its bets across all of them. No single company dominates. Compare that to another one called TrueShares Tech AI and Deep Learning ETF. That one holds only 20 stocks, and its top picks regularly make up 2/3 or more of the entire portfolio. Those are two completely different investment products with almost identical names. One is diversified and one is concentrated. Depending on which one you buy, you could be 40% up or 20% down over the same year. Most retail investors buying AI ETFs have no idea this is the case. AI ETFs versus Nasdaq. Here's the honest performance picture that no one will tell you. On the plus side, the average AI ETF has beaten the S&P 500 since 2016. 10 years. And that sounds good until you look at the next number. The same average AI ETF has failed to beat the Nasdaq 100 over that same period. Meaning if you had just bought the Nasdaq 100 index ETF, you'd have done better than if you would have bought the average AI branded fund for a fraction of the marketing hype. And this is what Morningstar's honest conclusion was from the article that I read on this. There's no compelling reason for most investors to go out of their way to invest into these thematic products. If you already hold a broad index fund, you're probably already somewhat invested in the AI theme for a fraction of these fees. I personally hold VTI, Vanguard's Total Stock Market ETF, and it gives me exposure to essentially every publicly traded company in the US. Thousands of them. Total expense ratio of 0.03%, basically free. And let me tell you what's inside the VTI. Nvidia, Microsoft, Alphabet, Meta, Amazon, Apple, Tesla, Oracle. Every single company that's driving the AI revolution. I already own them, and through a boring, simple index fund. If I added an AI ETF on top of that, I'd just be doubling up on stocks that I already own, paying extra fees, adding extra concentration risks, and there's really no upside to that. And this is Warren Buffett's argument for why low-cost index funds beat almost every actively managed product. The S&P 500 isn't just an index. It's a self-updating portfolio that automatically shifts to whatever companies are winning. AI companies are winning, so the index is already automatically loading up on them. You don't need to pick the AI winners. The market already does it for you. Now, here's something that might be on your mind. If AI can actually predict markets, then what's the point of money? Wouldn't whoever has the best AI just win all the money? This is a real question worth taking seriously, and let me share what I've learned. AI isn't new in finance. Ray Dalio, one of the greatest investors of all time at Bridgewater, has been using AI and machine learning to manage money since the 1990s. Renaissance Technologies, started by mathematician Jim Simmons, has been running algorithmic AI-driven trading for decades. They famously returned 60% per year in their flagship fund. Two Sigma manages roughly $60 billion using AI systems. So AI trading isn't the future. It's been present for the last 30 years. And here's what's actually true about it. One, the elite AI trading funds are invite only. Minimum investments are typically $5 million to $50 million. They deliberately keep retail investors out because their strategies don't work at small scales. Two, even those elite funds have been losing money. AI doesn't mean guaranteed returns. It means slightly better odds than humans compounded over time. Three, when someone pitches you a retail AI trading product with no minimum investment, that's almost always a marketing gimmick. The real AI funds don't need to advertise. The uncomfortable truth is that AI in finance creates a small advantage for people who can afford it, not a world-ending superpower. The old rules of investing still apply, and discipline still matters, and patience still matters. Your regular DCA into VTI, for example, probably beats 90% of retail AI products that you see advertised. And this isn't the first time that Wall Street has tried this kind of thing. In the late 1990s, every fund company launched an internet fund. They had names like Munda NetNet, Jacob Internet Fund, WWW Internet Fund Fury. They gathered billions of dollars from people who knew the internet was going to change the world and wanted a way to invest into it. The internet did change the world, but most of those funds collapsed spectacularly. Murder NetNet lost 79% of its value from 2000 to 2002, and some of those other funds completely disappeared. Meanwhile, the investors who just hold a boring index of the S&P 500, for example, came out far better off. Why? Because the fund companies weren't building good investment products. They were building marketing products that matched what retail investors wanted to buy at that moment. They charged higher prices and they had a concentrated risk because they assumed picking the internet winners wasn't an easy task. Sun Tzu wrote that in the midst of chaos there is opportunity, but he also wrote that the wise general avoids battles that he cannot win. You cannot win against Wall Street's marketing machine. They will always build the products that matches today's marketing hype. That hype right now is AI. Your only edge is to ignore the noise and hold on to the boring thing that works. Think long term. So my honest take on AI ETFs is, do you need one? I don't think you do, because you probably almost certainly own any significant AI company already through regular ETFs. For example, the VTI that I invest in holds most of them, just as I said. Are any of these worth considering? Maybe a few. If you must pick one, AIQ from Global X is diversified across 80 plus different stocks and has the largest assets of them all. That's probably the safest bet. BOTZ for robotics and AI combined. Both have been around long enough to evaluate. But I'm not buying either. I'm still sticking with VTI and dollar cost averaging into that every single month. I'll let the market automatically rebalance towards AI winners over time, and my assets will compound. Boring, consistent, but historically reliable. The investors who get rich from AI won't be those investing into AI ETFs. They'll be the ones who held quality growth companies through the volatility and compounded over 10, 20, 30 years into a significant asset. If this video saved you from making a bad ETF decision, subscribe. I'm doing at least 5 videos every week for long-term investors. I'll see you in the next one.